What if the biggest financial wins and losses you see aren't just about luck or skill? What if they're about psychology? We're taught to see finance as a world of numbers, of cold, hard data and rational choices. We look at charts, we read earnings reports, and we assume the person with the best spreadsheet wins. But that's an illusion. The real game, the one played by the ultra-wealthy to multiply their fortunes, has less to do with numbers than you think. It's about exploiting the predictable flaws in our own minds. Welcome to history's wealth playbook. The super-rich have become masters at understanding cognitive biases, which are basically the mental shortcuts our brains use every day. These aren't complex financial derivatives, they're fundamental quirks of human psychology. And the same shortcuts you and I take are the very things billionaires design deals around. They get that markets aren't just driven by balance sheets, they're driven by emotion, fear, greed, and the desperate urge to follow the crowd. In this video, we're going to dissect the real blueprint. You'll see the psychological tricks used every day and understand how your brain's natural tendencies can become someone else's financial superhighway. Imagine you're in a new city, looking for a place to eat. You see two restaurants side by side. One is buzzing with people laughing and talking. The other is completely empty. Which do you choose? Almost everyone picks the busy one. We just assume the crowd knows something we don't. The food must be better. It's a simple, logical shortcut. But what if the first few tables in that restaurant were filled with paid actors, all just to create the illusion of popularity? Suddenly, your rational shortcut has been hijacked. You were guided not by quality, but by a manufactured signal. This is the game. The ultra-wealthy don't just play in the market, they create the busy restaurant. They know the psychological triggers that make us feel safe, confident, or panicked. They know that when money is on the line, we aren't rational calculators. We're emotional creatures who love a good story, follow the herd, and fear losing more than we enjoy winning. And every single one of those instincts can be exploited. The financial world isn't a level playing field. It's a stage, and the wealthiest people are often the directors. Section 1. The social game, prestige, status, and herds. The most powerful set of biases are social. We're social animals, wired to survive in tribes, not to analyze stock portfolios. This means we're incredibly tuned into what others are doing, especially people with high status. First up is prestige bias. This is our brain's tendency to copy people who seem successful or high status. It's related to the halo effect, where we assume someone good at one thing, like acting or building a tech company, must be an expert in everything else, including investing. Would you buy a new cryptocurrency if a famous tech billionaire recommended it? A lot of people would, without a second thought. Their endorsement acts as a shortcut, saving us the trouble of doing our own homework. Billionaires get this. They use celebrity co-investors or feature them in press releases to create club deals that feel exclusive and pre-vetted. It's not just marketing, it's a psychological trigger that lowers our critical thinking and makes us feel like we're in on a sure thing. This bias was a key ingredient in one of history's most infamous frauds, the Bernie Madoff Ponzi scheme. Madoff wasn't just some random guy, he was the former chairman of the Nasdaq. He cultivated an aura of exclusivity that made it feel like a privilege to invest with him. While there were other factors at play, like huge regulatory failures and falsified documents, his success was fueled by his reputation. His clients weren't dumb, they were responding to powerful status cues that told their brains they were safe. They outsourced their trust to his prestige and walked right past the red flags. A famous name can often be more persuasive than a solid balance sheet. This leads directly to the second social bias, herd mentality. This is our tendency to do what everyone else is doing, even if it contradicts our own judgment. In finance, it means buying a stock just because it's going up and everyone is talking about it. It's driven by two powerful emotions, fear of missing out, FOMO, and the comforting feeling of safety in numbers. Financial history is just one story of a herd-driven bubble after another. Think of the dot-com bubble, where investors poured billions into internet companies with no revenue, just because everyone else was. More recently, the meme stock frenzy showed how social media can amplify herd behavior to absurd extremes, sending prices of companies like GameStop to the moon, completely disconnected from their actual value. But here's the part they don't tell you. For every stampeding herd, there's someone who profits from it. While the average investor is gripped by FOMO, the sophisticated investor is asking, who's selling while everyone else is buying? They often get in early, before the hype. In some cases, they might even help shape the narrative through media appearances or strategic interviews that spark the herd's interest. Then, as the crowd rushes in and pushes prices to euphoric highs, they quietly start selling their shares to the very people caught up in the frenzy. The herd provides the liquidity, the huge pool of buyers, that lets them exit their positions at maximum profit. They're trading on emotion, knowing that in markets, feelings can move prices just as much as facts. Section 2. The numbers game, anchoring and framing. If social biases exploit our need to belong, the next set of biases exploits how our brains handle numbers. The most fundamental of these is the anchoring bias. Anchoring is our tendency to latch onto the first piece of information we get, the anchor, when making a decision. Even if that anchor is completely random, it colors every judgment that follows. If you see a t-shirt for $1,200, then see another one for $100, the second one feels cheap. Your perception was anchored by that first, outrageous price. Now, let's apply this to venture capital and private equity, where valuing a young company is more art than science. Imagine a startup founder pitching to investors. There are no sales yet, just an idea. They don't start with a spreadsheet, they start with a story and an anchor. They'll talk about the total addressable market, or TAM, a massive number, often in the tens of billions. They'll say, we're going after a $50 billion market. If we capture just 1%, we're a $500 million company. That $50 billion number is the anchor. It's not reality, but it frames the entire conversation. Suddenly, investors aren't asking, is this idea worth anything? They're asking, how much of that $50 billion can they really get? Research on this bias suggests that the first number thrown out in a negotiation can have a huge, lingering impact. Billionaire investors use this from both sides. As founders, they set huge anchors. As investors, they know the numbers presented to them are tools of influence. They also use it to frame fees. 2% management fee sounds tiny. It anchors your mind on a small number. They rarely frame it in absolute dollars. That 2% on a multi-billion-dollar fund could mean tens of millions a year in fees, a number that would sound a lot more alarming if it were the anchor. By framing costs in percentages and anchoring valuations with huge future markets, they make expensive deals feel reasonable. This is especially dangerous when things are uncertain, because the less we know, the more we cling to the anchors we're given. Section 3. The story game, confirmation and narrative. Beyond social pressure and number tricks, there's a deeper game, the power of stories. This involves two intertwined biases, confirmation bias and the power of economic narratives. Confirmation bias is our habit of looking for information that confirms what we already believe. If you think a stock is a great investment, you'll subconsciously seek out news articles and comments that agree with you, while ignoring anything that contradicts your view. Our brains don't like to be wrong. Major investors and VCs can be very susceptible to this. They don't just invest in a business, they fall in love with a founder's story. Once they're in, confirmation bias kicks into high gear. They desperately want the company to succeed, so they'll celebrate rising user numbers while ignoring the fact that the company is burning through cash. A charismatic founder can feed this bias by selectively presenting only the good news, creating a compelling story of inevitable success that drowns out any skepticism. This is part of a grander strategy built around what Nobel laureate Robert Shiller calls narrative economics. His work shows that major economic events are often driven not by data, but by contagious stories that go viral, shaping our collective beliefs and actions. These stories are simple, emotional, and offer easy explanations for complex events. Billionaires are often the authors and amplifiers of these powerful narratives. When a VC invests in a company that claims it will disrupt transportation, they aren't just buying equity, they're funding a story. They use their capital and connections to spread that story through tech blogs and mainstream news. Soon, Everyone is talking about the future of transportation. This narrative can become a self-fulfilling prophecy, attracting more talent, more media, and most importantly, more investors. The investment is no longer about the company's performance, but about belief in the story. Think of narratives like digital gold for Bitcoin, or how certain tax cuts will automatically lead to prosperity. These are powerful stories that have directed trillions of dollars, sometimes with little connection to reality. A billionaire who can successfully launch and control a narrative can essentially create their own weather, generating a bubble around their assets by convincing the world to believe their story. By the time the story wears thin, its authors have often already sold their positions, leaving the believers holding the bag. Section 4. The ownership game, endowment and aversion. The next two biases are personal, rooted in our attachment to what we own and our fear of losing it. These are the endowment effect and loss aversion. The endowment effect is a funny quirk. We place a higher value on things just because we own them. If someone gives you a coffee mug, you'll likely demand more money to sell it than you would have paid to buy it. Ownership creates an emotional attachment that inflates value. Big companies have mastered this. Think about the digital ecosystems from Apple or Amazon. Once you have an iPhone, you start buying apps. You subscribe to Apple Music. Each purchase deepens your sense of ownership of the ecosystem. It's not just about convenience, it's a psychological trap. The thought of switching to Android and losing your apps and playlists feels like a huge loss, even if a competing phone is better or cheaper. This same principle powers subscription models. Once you subscribe to a service, it becomes part of your endowment. Canceling it feels like a loss, so we keep paying for things we don't use. This inertia is a reliable source of revenue. Financial firms do it too, bundling checking accounts, credit cards, and brokerage accounts. Unbundling them to find better deals elsewhere requires overcoming the endowment effect for each product, a task most people avoid. Paired with this is the even more powerful bias of loss aversion. Psychologically, the pain of losing is about twice as powerful as the pleasure of gaining. Losing $100 feels way worse than finding $100 feels good. This makes us terrified of making a decision that results in a loss. The financial industry uses this fear. Many investment funds have lockup periods or redemption windows, rules about when you can pull your money out. Section 5. The unfair levers, how biases are weaponized at scale. Understanding these biases is one thing. The real advantage comes when they're combined with structural levers of power that are only available to the ultra-wealthy. These levers turn a small psychological edge into a fortune-generating machine. The first is information asymmetry and authority bias. Put simply, they have access to more information, and they know that you know it. Authority bias is our tendency to trust people who seem like experts. When a big investment bank issues a buy rating or a famous billionaire announces a large position, we assume they've done their homework. The ultra-wealthy operate in a world of non-disclosure agreements and complex due diligence that's invisible to the public. A firm planning a takeover has a team of lawyers digging through a company's books for months. We just see a press release. This information gap allows them to plan their moves long before the market reacts. And when they finally do act, the authority of their name alone can trigger herd behavior, as everyone else scrambles to figure out what they know. While insider trading laws exist to prevent the use of material non-public information, there are many legal ways to leverage an information advantage. The second lever is scale and liquidity. When you're managing billions, you can profit from tiny market inefficiencies that are invisible to a small investor. But more importantly, your scale allows you to cause market movements. A retail investor buying a few shares doesn't move the price. A hedge fund buying a massive block of shares can create its own momentum, triggering algorithms and attracting other traders. Their participation changes the game for everyone else. Section 6. Case study, the anatomy of a billionaire play. Let's tie this all together with a hypothetical but familiar scenario, the IPO of a hyped-up tech company called InnovateX. While not every IPO follows this exact script, it illustrates a classic playbook. Step 1. The narrative and the anchor. Years before the IPO, InnovateX's charismatic founder starts pushing a powerful story. InnovateX isn't just a software company, it's going to revolutionize human connection. This is narrative capture. At the same time, they and their early VC backers set the anchor. They leak a desired valuation of $50 billion. The number is based on a wildly optimistic market size, but it becomes the benchmark. Step 2. The prestige and the confirmation. To build credibility, InnovateX's early funding rounds are a masterclass in prestige bias. They bring on a few celebrity investors. Their names are a powerful signal that validates the project. Meanwhile, confirmation bias runs wild. Investors, having bought the story, focus on positive news, like user growth, while ignoring the staggering cash burn. The story is too good to question. Step 3. The herd and the exit. On IPO day, there's a fever pitch of excitement. The retail herd stampedes, desperate to buy shares. They aren't buying a business, they're buying a piece of the story. But what are the insiders, the founder, the VCs, doing? They're selling. They have a planned exit strategy. Unburdened by the endowment effect, they see their shares as a financial tool, not an identity, and immune to the euphoria, they methodically sell their shares into the tidal wave of public buying pressure. They capitalize on the massive liquidity provided by the very herd they helped create. A year or two later, the narrative phrase, the promise of revolutionizing connection, gives way to missed earnings. The stock price plummets, maybe 70% from its high. The retail investors who bought at the peak, now gripped by loss aversion, hold on, hoping for a rebound that may never come. They're left holding the bag. The insiders, however, cashed out long ago. It wasn't luck. If you found this breakdown valuable, hit the like button and let us know your thoughts in the comments below. Have you seen these biases in action? And for more deep dives into the unseen forces of finance, make sure you subscribe to History's Wealth Playbook and turn on notifications. We'll see you in the next video.